Hello, and thank you for dialing into this roundtable discussion titled Africa's Post-COVID Recovery, which is being co-hosted by GTR and Crown Agents Bank. My name is Shannon Manders, and I'm GTR's editorial director. Over the course of the next hour or so, I'm going to be moderating a discussion about Africa's journey towards an inclusive, cohesive, and sustainable pandemic reality, addressing themes such as the role of trade and trade finance, access to vaccines, ESG efforts, and digital trade. And in doing so, I am joined by a fantastic lineup of speakers. So I'd like to start off by asking each of them to just very briefly introduce themselves to you. Let's begin with you, Duarte.
Hello, I'm Duarte Pedreira. First and foremost, absolutely delighted to be co-hosting this roundtable with GTR. Thanks to all the speakers for agreeing to take part. I head emerging and frontier markets for Crown Agents Bank, and I'm also a board member of the global trade finance industry body, the ITFA.
Hi everybody, I'm Emma Wade-Smith and I represent the UK government as Her Majesty's Trade Commissioner in Africa, based in South Africa with trade and investment teams across 21 African countries, really trying to drive the value and the volume of trade and investment between the African continent and the United Kingdom.
Afternoon everyone, Ian Henderson, CIO of Artis Finance, also an advisor to the Baye Foundation and Orbit Capital.
Good afternoon to everybody. My name is Bleming Nekati. I work for the African Development Bank as a Chief Trade Finance Officer, sitting in the bank's offices within Southern Africa, which are here in Pretoria and Centurion. I look after the bank's operations that cover 13 African countries in the region, deploying an array of our interventions within the financial sector. So very excited to be joining this esteemed team of panelists. Looking forward to the discussions today. Thank you.
Hi, I'm Ted George. I'm the founder and chief narrative officer of Playos Advisory. And what we do is thought leadership and strategic advisory on African markets, commodity value chains, and fintech. And where they all cross over is the sweet spot, things like trade tech. Some of you will know me from before. I was head of research at EcoBank as well, and I've done one or two things with GTR over the years.
Thank you, and good morning and good afternoon, colleagues, wherever you are. My name is Victor Mashoko. I work for Afreximbank. I am Senior Manager of Structured Trade and Commodity Finance. I look after 13 countries within our coverage, and I sit in Harare, Zimbabwe. Thank you.
Hi, everyone. My name is Makiko Toyoda. I'm acting head of Global Trade Finance Program at IFC. I have been doing this acting job since 2017. Before that, I was based in Johannesburg, in charge of Sub-Saharan Africa market. Thank you.
Well, thank you. And thanks to you all, as Duarte for joining the discussion today. It's great to have so many familiar faces from all across the globe. Now, moving on to our questions. As we all know, African countries, like countries all over the world, are yet to see the light at the end of the tunnel of the COVID-19 crisis. But the United Nations has said just very recently, a few months ago, that African countries must quickly initiate deep economic reforms to prepare for their future. So my question to you is, what does Africa need to begin these reforms and reduce the financing and infrastructure gap that curtailed the continent's development even prior to the crisis, and which may now become a threat to its post-pandemic economic recovery? Not a small question to get us started, but Duarte, maybe you'd like to take the first stab at the question.
Sure, absolutely. I mean, I think what we're presented here is a perfect opportunity for a somewhat peaceful revolution. I think Africa has been somewhat plagued maybe by the old trading models that externalized value creation and basically focused the continent's trading into exportation of unprocessed commodities and importation of value-added goods. I mean, the tide has changed dramatically, and I hope it is somewhat consensual amongst my fellow African enthusiasts in this panel that the topic of a somewhat benign African nationalism, economic nationalism, is now prevailing. So Africa is turning into the internalization of value add as such within the continent, and it's basically realigning the continent's ambitions with these value-added industries, with a huge focus on technology, and of course the newly created and now operational Africa Continental Free Trade Area will be a big part of that. Now I think the paradigm is shifting. It's no longer about foreign entities coming into Africa to buy commodities, taking them out, and then, like I said, exporting them back to Africa as value-added goods. Right now is about production, or should be about production of value-added goods in Africa for them to be distributed in Africa. So it becomes a little bit of a privilege as such to have access to this, as I said, newly created trade area, which is second only to the WTO in recent years. And effectively, we are now seeing the production of mobile phones in places like South Africa, Rwanda, soon to be Nigeria, computers, electricity meters, etc., all powered by technology. So I think the infrastructure will then come on the back of this, because the retention of value in Africa will be able to generate this equity layer that then allows African sovereigns to reinvest effectively in logistics to make this intra-Africa trade and intra-Africa value creation a reality.
Thanks, Bart. You covered a lot of key themes there, but I'm going to ask the same question to Blemming. What do you think, Blemming, Africa needs in order to begin these reforms and start this recovery?
You know, for me, it would be remiss if I don't start off by just acknowledging the negative impact that COVID-19 has caused on the continent. It has been unprecedented in terms of scale and nature. And one only needs to look at the severe strain on public finances, and you look at fiscal deficits all around us. You know, they've been widening. In terms of debt levels, you're talking of 80% of GDP, which is quite unsustainable. And our figures, including what is coming out of the IMF, is showing that Africa is going to need, in particular sub-Saharan Africa, is going to need 425 billion between now and the end of 2025. So it means that all hands needs to be on deck. And from where we sit, we've already tried to respond and assist, because we see a lot of vulnerabilities happening across a number of countries. The first thing that we've done is obviously to put in place a $10 billion US facility that we call COVID-19 Rapid Response Facility. And this has been aimed at helping a number of countries that were constrained by the fiscal challenges that emerged. We have also, since around 2020, launched a $3 billion US COVID-19 special social bond, and this was overly subscribed, being the largest USD denominated bond of a social nature that has ever been floated out there. And as we speak, this bond is listed on a number of stock exchanges, including the London Stock Exchange, the NASDAQ, and on Luxembourg. So we are looking at doing something in order to respond in the immediate term to the impact that has been caused by COVID. Now, coming to the infrastructure gap, our estimates have always shown that Africa needs between 70 and $110 billion in order to cover that gap. But this is a huge job that needs many other players to play a role. We are playing our part by doing a lot of work in deepening and broadening capital markets, by providing, your technical assistance support so that you can assist and add technical skills that are needed in this space. We also engage ourselves in policy dialogue, with public sector colleagues so that they can put an enabling environment that allows the development of capital markets. It is only when capital markets are deeper that you can raise the necessary funding you require to support both investment requirements as well as the infrastructure requirements. Then also, I think a lot of work that we continue to do within the infrastructure space is helping eligible participants, like your governments, like your public bodies, regional economic blocks, to develop projects of a regional nature, infrastructure nature. And we provide these resources using our NEPAD IPPF, or what we call Infrastructure Project Preparation Facility, that helps them, bring projects to bankability and also help them, raise funding. And in the end, you kind of assist them in getting financial closure, because the gap that we're talking about here is massive. The last point I wanted to raise is the work that we're doing using the African Investment Forum. This is a platform that brings together, many stakeholders, multidisciplinary in nature, and that platform then allows investors and those with projects to come together. What we've done in 2019 with the launch of the African Investment Forum was to table a number of deals there, 57 in total, with a value of about $68 billion. And these were discussed, they were considered, and about 52 deals from that, with about $40 billion, managed to secure investments. So I think I'll stop here for now, but in a way, we are kind of intervening to try and help reduce the gap on the infrastructure side, but also to try and deal with the challenges that have come from COVID-19.
Yeah.
Thank you.
Thanks, Bleming. And I think it's so important to quantify the scale of the problem, and also the various roles that your institutions have played in trying to close that gap throughout the crisis. And we'll come on to some more of that later on. But Emma, I just want to come to you for your thoughts on this first question. Bleming said, "All hands on deck." Would you agree with that?
Absolutely. I think it's really interesting to hear what the UN has said. I think it mirrors what many organizations and institutions have said, not just in a sort of during COVID, but actually pre-COVID. The idea that we need to see economic reforms, that we need to see an improved business environment, tackling market access barriers to enable more companies to grow, create jobs, and trade within themselves and across national borders in Africa. This isn't new, but I think it's been exacerbated, of course, by the economic devastation that COVID-19 has and continues to play out in Africa. And similarly, the financing gap, the infrastructure gap, none of these things are new either. Bleming talked about the African Investor Forum. I remember in 2019 sitting there listening to a panel, and people were saying, look, if we're still talking about this stuff in 10 years' time, then we haven't done what we need to do. So none of this stuff is new, but you've shone a stronger spotlight on it because of what we've seen COVID-19 do to our economies across the continent. And I think picking up Bleming's point about capital markets, I think that's really important. We've seen stock exchanges like the London Stock Exchange Group working with stock exchanges in Africa to try to build greater, deeper resilience in African capital markets. UK government has also supported the Financial Sector Deepening Africa programme, all designed to enable Africa to create wealth itself. And I think what is interesting about COVID is the way that it has made us all think about, you know, building forward better, building back better, whatever phrase you want to use, but really with a focus around sustainability, inclusion, resilience, you know, greener growth, and that's been a strong factor for us as the UK government for some time, thinking about how do we help Africa's continued economic growth. And I think it's taken on an additional dimension in the context of COVID. You know, Duarte mentioned technology, and I think, you know, when we're looking at reforms and we're looking at how do you kind of get greater access to finance, how do you build sustainable infrastructure so that we're not building stranded assets for the future, technology really can play a part in all of that. And I think we've seen that really accelerate over the last 12 to 18 months or so. But I think fundamentally, you know, we've seen money flows change direction quite a lot over the last 18 months. You know, that particularly in the first months of the pandemic, we saw money flowing out of Africa at really alarming rates. And what we need to do to attract money back to Africa, I think, is to see more governments being even more committed to making the reforms that will entice money back to really provide the financing, the investment that our economies need, not just in infrastructure, but across, you know, education, healthcare, agriculture. You know, Africa's economies need that international investment, and the best way to do it is to create you know, really exciting dynamic economies through making reforms, through tackling regulatory, some of the outdated regulations that are hampering the flow of business activity. So plenty to do. And as I say, I think the pandemic has really accelerated the demand for that action and shone a spotlight on the need for it.
Thanks, Emma. So, you know, one thing that binds us all, besides the African continent, is obviously trade and trade finance. So my next question to you is, what role does trade and trade finance play in Africa's economic recovery? Makiko, I'm gonna come to you in the first instance on this one.
Thank you, Shannon, for this question. We all know that every 1% point increase in trade will induce 2% point increase in income per capita. So we all think that the trade actually drives everything in the economic recovery stage. I think from IFC's point of view, we think that private sector is really key to promote this economic recovery stage. And so everything starts from trade. I think without trade, production starts, any operation starts. So I think this is the beginning of the recovery stage where all government parties, also the multilateral development banks like African Bank, African Development Bank, and IFC, we all have to come together to support these trade activities. Otherwise, nothing will start. I think it's already said in the previous questions, but vaccine access is everything to start the economy, I think. And then we have to import vaccine on the continent to start everything. We will talk about the local production of vaccine later on, but then you need to import vaccine inputs in order to produce locally. So I think in terms of the sequence of the economic recovery, trade will start everything, and then after that, operation will start, production will start, the economic recovery stage is coming on. So from IFC, we try to initiate new activities, which is called Africa Trade Recovery Support Initiative. And then this is really the World Bank Group's focus to maybe spotlight trade importance. And then we support trade finance supply in the market so that the continent would be able to utilize those supply of trade finance and revive the economy.
Victor, let's come to you at African Bank. What is the role of trade and trade finance in the continent's recovery from where you're sitting?
Thank you, Shannon. Trade finance still have a role to play in the continent, in particular, keeping the trade in goods and services flowing, presents not only an economic but also a social imperative to preserve the livelihoods of millions in the continent. Pre-COVID, the trade finance gap in Africa was estimated to be about 81 billion, and trade finance has a role to reduce that gap. The trade finance will also play a role in providing instruments to finance short-term working capital requirements, which include sectors like the health, medical supplies, which has expanded dramatically following the onset of COVID. So I think the role also being played by DFIs should continue to invest in the continent by supporting the financing of trade finance. Several rapid responses facility and programs have been launched by DFIs, both global and on the African continent, and also multilateral development banks who help the recovery of trade finance in the continent. So trade finance still remain relevant to provide working capital requirements for a steady economic activity. So I think to show the relevance of trade finance in the continent, Afreximbank also introduced a 3 billion trade pandemic impact mitigation facility, what we call PATINFA. And this was with a view of alleviating the impact of COVID on member countries, as well as also to meet trade finance related payment fallout facility, which were due as a result of COVID. So basically, under the PATINFA, the bank provided financing to governments, central banks, commercial banks, also sub-regional development banks, and various corporates through the various trade finance instruments, such as term loans, lines of credit, guarantees. And as of December 2020, I think the bank, we disbursed about almost about 6.5 billion to 7 billion in under that facility. Prior to COVID, I think also the bank, in an effort to ensure that trade finance remain relevant and also to reduce the trade finance gap, Afreximbank also introduced what we call the Afreximbank Trade Facilitation Program, whereby we wanted to replace actually the international banks that had withdrawn from the African continent through the issuance and confirmation of letters of credit. So I think this program is ongoing, and also it has also been alleviated by the onset of the COVID pandemic. And over and above the PATINFA that I've alluded to, also the Afreximbank also in collaboration with UNECA, that is the Africa Center for Disease Control, also supported the continent with a facility, what we call the UNECA facility, whereby the bank also committed about 200 million to try and support existing African manufacturers of COVID materials and African manufacturers. And so it all shows how relevant trade finance within the continent is prevalent. Thank you, Shannon.
Thank you, Victor. And we're so lucky to be joined by such a wide variety of panelists. So let's come to you, Ian, and get your view from a non-bank financial institutions perspective.
Yeah, thanks, Shannon. And yeah, to all the other speakers' points, I think obviously the African trade gap is growing, and we've seen dramatic impact across the continent following COVID. Unfortunately, I don't think the world is fully aware. Everyone talks about the global supply chains, and people forget what an impact it's had on a very simple import or export out of an African country where you just can't get a container, or what cost $5,000 12 months ago cost $20,000 today. These are major impacts for relatively small businesses when talking on global terms. So I don't think the full impact is known. I think we still got more road to go before we see the impact. But certainly, the DFIs have stepped up to the plate. They seem to be doing a lot. The multilaterals. I think what's next is the banks, and then the alternative section. And by alternatives, I talk about funds, fintechs, platforms, and local platforms. I think the other route to try and improve trade finance in the continent is look at domestic currency financing and local currency finance. Everyone thinks trade should be in hard currency, but we've seen the impact on the local currencies. You just look at Zambia and some of the other East African currencies and Central African currencies. They've been decimated over the last 18 months. And hard currency funding, it causes further problems. So I think we really got to look at mechanisms to improve local currency funding. And I think one of the routes is to look at using capital market type structures in local economies, much like we do in Europe and the US. And there are countries that could probably cater with this, places like Ivory Coast, Nigeria, Kenya, South Africa, certainly. So I think people have to start being a bit more creative and looking at their own countries and their own investors. I think also the alternatives, and we need more African alternatives, to be perfectly honest. We don't see too many African-owned and African-driven funds coming up. There's maybe one or two. And I think that's where we need to encourage more growth to complement what banks, DFIs, and multilaterals are doing. So, in our role, although we sit in London and we're very much a non-bank lender and we tap the capital markets, whilst we look at what we do on the continent, these are all focused around local currency, sort of securitization type structures that we might be able to employ in specific countries. So that's where we're doing a lot of development work. We're also doing development work around assisting emerging market banks, in particular African banks, that cannot get confirmation lines or trade finance lines from foreign banks any longer. And really taking a receivables type approach to their business and saying, here's a letter of credit issued by a reputable African bank. Yes, it doesn't have a confirmation from an A-rated bank in Europe or the US, but that paper is still good. So, we will fund that and we'll put that into a vehicle where foreign investors might be prepared to buy that type of paper. So I think this is how we're trying to broaden the canvas. Another key point for my involvement, say with the Baye Foundation, is education. We spend time with small SMEs across the continent that might have a viable business. And we take those business owners and give them a fellow who guides them through improving their budgeting, improving their governance, their presentation and structures, just so that they can access local banks and local funders. Because before, they may have not considered trade finance. They may not know what a discount is, or other than an overdraft or having a mortgage over fixed property to raise money. So it's really education plays a key role on the continent at all levels, because I think the gap exists at all levels on the African continent when we talk about trade and finance in general. So whilst we can try and work on the financing side, I think there's a role to be played by all of us that are involved in improving the skills. And it's not really hard education, but it's soft skills. How do you make your presentations look better? Get the terminology right. Understand what an import and export is. Do you understand what discount means? So very simple terms, but I think once people start hearing these and understand them, they can actually present themselves to more financiers on a more accessible level. So I think there's a number of ways that trade plays a role, and we mustn't forget, trade finance deals with the real economy, and with it, those that are involved in trade finance and trade finance investment, we have a responsibility to ensure both the financing and the investor is sustainable and has responsibility attached to it.
Thanks, Ian. Ted, I'm really keen to hear what your thoughts are on the role of trade and trade finance in the continent's recovery.
Yes, thanks. I think a lot has already been said, and it's really clear that so many of the banks and the institutions and the NBFIs as well are looking at different ways that they can help out. But I think the interesting thing, just to add to what's already been said, is that, crisis is nothing new to trade finance. Trade finance is designed specifically to be short-term, to be flexible. There are so many different ways that it can work as a model to address a crisis. And Africa is no newcomer to crisis. It's been dealt with many times. And I've seen a lot of examples of trade finance still flowing. There are major gaps, but I think the basic point is Africa and trade is designed in order to deal with a huge impact, maybe nothing as large as this, but the structures and the knowledge is there to get through this. But I think the other thing is, to get back to Neil's point as well, it's quite interesting he talked about the real economy. You could say the real economy of Africa is driven by SMEs. They are basically the entire economy, 90%. And SMEs are primarily involved in retail and trade. And every retail requires trade anyway. So the thing is, if you can boost trade, you can boost the economy. And I think what's really interesting is that any effort to do that always results in better economic growth and more opportunities for entrepreneurs. And Africans are very entrepreneurial. But then I think the other thing is just about what trade can do. It can drive a very different agenda. It's not always about trade. If you just think about wanting to increase transparency and accountability and stamping out fraud and environmental damage and forced labor, etc. All of those things come from a trade agenda. You think of the regulations, ESG. I think we'll talk about that a bit later. But that is driving a reform agenda as well in Africa, particularly in markets where they want to keep trading. And then if you think of the whole agenda of integration, the AFCFTA, which has already been mentioned, that's not just about trade integration. That can really help drive integration of legal systems, integration of financial systems, integration of cultures as well. I mean, there's so much things it can actually drive, even though trade is the economic factor underneath. But I think for me, the real bonus here, that what trade can drive as well, is this idea of value addition. And this gets back to Duarte's point at the beginning. One of the things really lacking in Africa is cross-border value chains in, let's say, soft commodities that serve African markets. There are some, but they're relatively few. The idea that you can grow or import soft commodities in one market, semi-process them, export them across the border seamlessly, straight into another value chain to be turned into whatever products there are. That's done a bit, but not much in Africa because there are so many uncertainties at the border. So what I could really see trade driving here, particularly as we move out of COVID, is actually this idea of a cross-border value chain. And that's how you capture the value in Africa, because you're selling a lot of it in Africa too.
Thanks, Ted. Let's move on. Now, there was an Afreximbank and AFDB report that came out earlier this year that GTR covered, which talks about the damage wrought by the pandemic on banks' trade finance business. So my question, and maybe Blemming, I'll start with you. My question is, what have been your observations of trade finance trends, such as declining correspondent banking relationships, FX concerns, as well as trade finance demands over the last 18 months since the start of the pandemic? So trade finance trends and trade finance demands, and how this is impacting the trade finance gap. Blemming, let's start with you.
Yeah, no, thanks, Shannon. The gap is been said by many people on this roundtable. We know about it. We have published extensively as the African Development Bank. The figures are anyway, between 90 billion, 110 billion US dollars, which would require that, institutions who are involved in this space play a role. Now, the reference you made to the report that we did a survey as part of producing that report. And what came out of it was that there was a lot of pressure on availability of support by international banks. So correspondent banking relationships were affected negatively, although demand from African issuing banks continued to increase, given that there was a lot of demand from their own clients. Reasons that were provided on why international banking entities were not keen to do more business on the continent the past year or so pertains to increased risk perception associated with clients that are domiciled on the continent. The record downgrades that we experienced during that period also were not helpful, because then once the sovereign risk rating is downgraded, that affects all companies that are operating within that environment. That kind of made international banking groups uncomfortable, and they were not that keen to be extending their limits in a similar way they had been doing years prior to the pandemic. We also found that there was an inability to comply with pre-existing legal or regulatory requirements in various jurisdictions, either where the correspondent banks are domiciled or where the issuing banks are, that is more on the continent. The containment measures that were instituted by various governments in response to the pandemic made it difficult for compliance with some of the legal regulatory requirements that were already there. And normally international banks, before they onboard issuing banks from the continent, they want to have comfort, and this comfort comes from their ability to come out, perform a due diligence, and ensure that KYC issues are sorted out, tick all the boxes, and then they can extend a limit. Because of the restrictive measures, which made it difficult for people to move around, and do business normally the way we've always known, made it extremely difficult for international banks to do business on the continent. But you see, despite these challenges that we faced, the African Development Bank continued to take bold steps. I already mentioned, which I will not repeat, 2 interventions pertaining to the COVID response facility, the social bond that we raised. But we have also an array of risk mitigation instruments that we've continued to extend. These risk mitigation instruments, for instance, an instrument that we call Risk Participation Agreement, is targeted at giving comfort to international confirming banks so that they can have a reduced risk capital allocation whenever they are underwriting risk that is originating from Africa. So that instrument, we continue to deploy it, and a number of international banks found comfort in working with us. We were renting our AAA rating onto them so that they could take on more risk and continue to support trade on the continent. We also introduced a new instrument that we call a transaction guarantee facility. By this instrument, what we're going to be doing is performing a due diligence and an appraisal of all issuing banks across a number of African countries, and then we extend limits on these. By so doing, what that does is it helps those issuing banks which might not have an acceptable credit record on the face of these international confirming banks, and then they would have more comfort in taking on board the transactions that are originating from these banks. Then I think the other point that I want to raise is the challenge with anti-money laundering, KYC compliance. We see that this has increased the cost of due diligence that an international bank would like to do before they can onboard local banks on the continent. And we see our role in this space in helping reduce the cost of due diligence by working with other institutions like Afrexim Bank in finding, putting in place digital platforms that can help African issuing banks to deal with compliance issues, as well as capacity building just for them to have systems within their own institutions that can make compliance issues easier. I think I'll stop here for now. Thank you.
Thanks, Fleming. Duarte, just a heads up, I'm going to come to you on this question in a sec, but first I'm going to hand over to Victor to see if he has any add-ons to that report, which obviously Afrexim Bank contributed to as well.
Thank you very much. I think Fleming has summarized it all, given the joint survey which was done by AFDB and Afrexim Bank. Yes, I'll just talk about there have been cancellations of correspondent banking relationship, which resulted in the decrease of confirmation lines. And the cancellation and reduction was mainly attributed to the deterioration perceptions of the risk profiles of end clients. And also global banks, which pulled out of the market that they perceived to be too risky, which led to many African banks at risk of not being able to conduct trade in foreign currency. So given that commodity trade is predominantly priced in US dollars, African trade in particular is mostly vulnerable to correspondent banking relationships, which affect Forex earnings. So the massive exodus of these international banks from the African correspondent banking space first triggered the compliance, and this increased also the KYC and anti-money laundering regulatory environments. Even became more heavily felt during this COVID-19 pandemic. So as alluded before, that maybe as Afrexim Bank and as the trade finance leader in Africa, we introduced some initiatives to help the member countries deal with COVID, the fallout of the also the correspondent banking within the African continent. So I think in a nutshell, I think that's what we did, and I've alluded to the intervention that we did in line with the COVID response. Thank you.
Thanks, Victor. Duarte.
Thank you very much. I think there are so many angles here. It's even hard to choose one where to begin. First and foremost, I think we can't ignore that the demand for trade finance has also gone down a bit in Africa, further to the COVID pandemic. You know, economic activity goes down, demand for trade goes down. However, the scary thought here, and which has been captured very well in the work that Afreximbank and African Development Bank have done jointly, is that the supply of trade finance has gone down further. And this is where it becomes really, really concerning. So, you know, kudos to Afreximbank and African Development Bank, the IFC, ATI. Africa has really shown that African institutions can step up to the plate and support the continent. So that's really important. In light of my initial intervention that called for a bit more of African economic nationalism, which, by the way, doesn't mean closed borders in terms of trade. It just means that the trade is done in contrast with the old models. But I think financial institutions and development financial institutions in Africa supporting African business is just fantastic news. Now, in terms of correspondent banking, undoubtedly, there is a massive, massive exodus of, particularly around the US dollar space. And banks in Africa, quite a few of them are being left without access to the international markets, or with just single access, which leaves them heavily dependent on pricing considerations and sometimes making their business quite unfeasible. Now, people do talk about, and especially in these surveys, and I'm not contesting, of course, the validity of the answers, but people do talk a lot about compliance issues. I would dispute that anytime. I think compliance issues are there, of course, but these compliance issues are only prompting different issues, which are of a commercial nature. Correspondent banks are exiting more because the revenue that they can generate from a tier 2, tier 3 African bank does not compensate the amount that they have to invest as forced by their own regulators to actually keep these relationships afloat. So I would probably escalate the question to the regulators in terms of, have we gone too far? Or maybe we haven't gone too far, but maybe we haven't provided the right framework for correspondent banks to provide their services in a way that makes commercial sense. The second point is around foreign exchange. I mean, undoubtedly, there have been issues, and Ted's alluded to a couple of countries that perhaps mismanaged their FX positions at a country level, sovereign level. And my anxiety is that perhaps the COVID situation has led to the somewhat increase in terms of sovereign bilateral loans. And of course, China springs to mind, but China is not the only culprit here, which may in the future continue the dependency that Africa has got on these commodities for development type of arrangements. And of course, that is detrimental to that value add conversation that we were having at the beginning. But finally, and this goes hand in hand with what Ted was advocating as well, I think, my overarching question around the trade finance gap is, are we focusing still on the right trade finance for Africa? Does it make sense in the context of a value-adding Africa to continue talking about exclusively import LCs and pre-export finance, prepayment finance, tolling finance, which are all linked to commodities? You know, where are the development frameworks for supply chain finance? Technology-led supply chain finance between countries. This is what the sort of the pillar of the ACFTA should be creating a receivables discounting platforms targeted at SMEs, using technology to effectively overcome or simplify the KYC issues and the regulatory issues around SMEs.
So many questions, Duarte. Makiko, you have something to add. Let's come to you.
Thank you, Shannon. Just to make a comment, I was inspired by what Duarte said, but then IFC also did a survey during the COVID last year, and then I agree with what Victor and Breming said, but the correspondent banking relationship challenge was really tough for the African markets. In IFC's space, in GTFP's network, about 30% of the African bank has less than 5 correspondent banking relationships. So this issue is really crucial for our network. And then about 40% of the network was saying that they had correspondent banking relationship stress during the COVID. Out of 163 respondents from this survey, 23 banks confirmed that their lines were actually cut during the COVID. So this is a significantly high numbers that we experienced during the COVID. I think we also heard about this Forex concerns. This type of Forex limitation is really hurting our African banking network. I think 52% of the respondents said that they had liquidity issues coming from the Forex concern. Liquidity control is another issue that we have to ask our government counterparts to think about those policy change, because this is really hurting these African markets. But then just to make one comment about what Duarte said, yes, maybe we need innovation here. Maybe thanks to COVID, this is a good timing momentum to change this African market, to see what we can introduce some digitization in this space. Supply chain is really a key in this market moving forward. IFC is also trying to help these reverse factoring markets to see if we can support those supply chain financing needs in Africa. But then 91% of our respondents in our survey requested some sort of assistance in the digitalization education. So I totally agree with what Duarte said, that what African market needs is now really innovative way to jumpstart the digitalization. Supply chain is key to move forward, I think. Thank you.
Thanks, Makiko. And that very neatly takes us on to the next topic that I wanted to discuss with you today, which is innovation, technology. You, Makiko and Duarte have talked about this, and digital trade. And Ted, I want to come to you in the first instance on this question, please. How can digital trade, help fight the consequences of COVID-19 and support this economic recovery that we've been talking about? Obviously, there's challenges as there are, elsewhere in the world, and Africa is on a digital trade journey. But how can it make good on the progress that it's achieved so far, and gain more ground in that?
Yeah, it's a difficult one, that, because I think basically there's a process underway, which is the digitalization of all trade and all of the economy. And some of it has been sped up incredibly fast by COVID. So I think what's so interesting about the process we've been through when we look at what's called trade tech, which is bringing together all those different bits of technologies in different ways, is that some of it is actually very old. I mean, stuff like, electronic signatures and being able to approve things digitally. I mean, even like, fingerprint recognition, etc. It's just the way that people have used them, the way they've been deployed, and particularly how they've been accepted has been a major barrier to it. And so this has just been forced on many people. So I think we've definitely gone past a point of no return when it comes to what you can do with the technology. I think what's so interesting in terms of what trade tech can deliver is everything to do with transparency, efficiency, and then really addressing these issues of ESG, which is no longer kind of a nice to have, but is really kind of central. So I think, like, if you look at the tech, just on the first level, everything to do with efficiency. So obviously efficiency of documentation, payments, approvals, KYC processes, everyone knows about that. There's a whole host of technology there as well. But what I'm thinking about is the efficiency of actually production. particularly if you're looking at crops. So, you know, there's a number of companies that can use drones, they use satellite data and sensors. They can tell you in an area straight away if there's an outbreak of disease, if there's an unusual fire, where do you actually spray, and more importantly, where do you not spray? I mean, all that sort of stuff with much better crunching of data. That means you start getting those yields that everyone's been talking about. And the thing is, you have the ability to look, even if something like cocoa, which does tend to be small individual farmers, and you can really see over an entire area who's doing well and who's doing not so well. And you can often tell, I mean, exactly from photographs, if people have encroached on land they shouldn't be on. So I think all that sort of stuff is really important, because I think it's already been said earlier today that, you know, as we move into the post-COVID phase, there's a real need to actually see that as we rebuild, we're not going to be rebuilding just as it was bad before, building forward, as you said, Emma. And I think this is what's really important about what trade tech can do, because at its core, it's all about delivering transparency, efficiency. And the thing is, if you have proper transparency, you hugely reduce the possibilities for fraud and for you know, embezzlement and theft, and also this whole thing of people getting a fair share of the pie. You know, as you get more and more clearer, as more and more, let's say, of the farmers and the traders are integrated into this digital value chain, they become part of the employees. There is a possibility for them to be properly recompensed. As we currently are with trade, so much of it is fragmented. You have no idea who is actually benefiting from the trade flows. So I think it can deliver a really fantastic agenda, but certainly in the short term, the key things it's doing is it's helping the trade keep flowing.
Yeah, well said, Ted. It is a massive topic, but you've done well to cover most of it. Emma, let's come to you on this topic.
Yeah, look, I think Ted's captured this really well. And I think with the enthusiasm that digital trade and digitization deserves, actually, because I think it really does have the ability to be transformational. Where we've seen digital trade or digital technology, or indeed any types of innovation that are creating online abilities for people, for citizens to do government services, get a driving license or apply for a passport, or get their forms uploaded for their trade. It just really helps. It's cheaper, it's way more efficient. It really helps to tackle the challenges around risk perception and risk reality in Africa. And I think you can see how governments can generate more tax revenue on the back of enhanced digital trade and digitization. Fantastic UK company, Ordnance Survey, when they've gone into a country and they've mapped the land use and just the whole land area, it's amazing the impact it can have on government revenue generation and driving economic growth. And actually thinking about it from that perspective is quite transformational to think as a government, many of which are really struggling to generate the revenues they need to pay for not just the infrastructure, but everything else that is required of them. That should be a really attractive offer. I think what it also does is really stimulate the fourth industrial revolution type jobs. We often talk about job creation, but you look at somewhere like Lagos, the coding capital of the world now, being able to really drive technology from Africa, I think is really powerful and has the ability to change people's lives from a job perspective, as well as kind of, if you like, a client relationship experience perspective. But I think what's also really required there is for governments and regulators to understand what is required of us to create the environment within which digital trade can flow, within which digitization is enhanced. So tackling regulations, making sure that they're fit for purpose and that they are modern, and that they're creating the right sort of drivers for this change. I think it's also really important for inclusion. And so we've particularly seen this, I think, through fintech and mobile money, where it is enabling the unbanked often women, but those working in the informal economies around Africa, to suddenly get access to a greater sort of sense of financial inclusion, financial education, financial literacy. So we're empowering more people across the continent to have control of their lives, to be able to afford some of these microfinancing options that are now available through technology on the insurance side, for example, all of which helps to build more resilient economies for the future, so we can bounce back not just from pandemics, but from locust infestations, from flooding, from drought, and so on, bridge collapses and so on, which can be absolutely devastating for far too long, for far too many people, because of the absence of insurance for so many. Thanks.
Thank you, Emma. Now, I'm really conscious of time, and also conscious of the fact that we have two quite big topics related to this idea of innovation and supply chains that I want to cover with you all today. The one is, excuse me, ESG, and the other is vaccine access. So let's start off with ESG. And Ian, I'm going to come to you in the first instance on this one. I mean, we've talked about it already on today's discussion. We've seen the momentum building around the ESG agenda globally, driven by all sorts of things such as government initiatives, stakeholder activism, investors, pressure, efforts to diversify away from oil and gas. But how is the situation developing in Africa? Are we seeing any sort of signs to indicate, the success of and opportunities available to companies committed to integrating these ESG goals into their corporate and investment strategies? What sort of progress are we seeing?
So Shannon, I think ESG has become such a broad topic now, and everyone refers to it fairly loosely, unfortunately. And I think it's necessary. So I think you've got to look at the different elements that you're trying to achieve with it. So I think we've got impact funds, we've got the DFIs who are very strong on the SDGs and trying to promote those goals. So I think we probably need some more alignment on the objectives when we talk about ESG. So I think obviously from an investor, yes, ESG has sort of been around for some time, but here I'm talking about large institutional investors who have internal policies and minimum requirements to meet. We've seen some of those adapted by some of the bigger banks across Africa and some of the multilaterals that all have ESG pages or policies or sustainability policies. And I think we've probably got to drill down a bit more on what that means on the ground in Africa. And I think I spoke about it a bit earlier. It comes down to the education phase. So I think beyond the finances, we've got to talk to the entrepreneurs and the SMEs on the ground. And now to a lot of these people, they just need basic guidance on what are we talking about. For some of them, just having an employment policy in place or equitable employment strategy, these are not things they may have ever considered. So it's just making them aware of them and getting that basic information across. Because in my mind, the E part, I think there's a lot of world focus on it and everyone's aware of the climatic impact and the environmental damage and how we're trying to address that. Social to a certain extent, but around the governance, and this leads into the AML and the KYC and just facilitating finance, that's where a lot of entrepreneurs and SMEs need the guidance. And it's not really shaking a rule book at them. It's not placing an external auditor in front of them. It's just getting them up to speed with basic good business practice to start off with. So I think if you start driving good business practice, that drives a lot of the governance side. On the S component, every institution looks at different factors in their ESG modeling and impact modeling, and it's which SDGs are you going to follow? There's 16 SDGs, or there may be too many. And I think you find institutions start focusing on 3 or 4 key elements, and each investor pool is different. So, some poor target company or borrower suddenly is faced with trying to accommodate different demands from 3 or 4 different borrowers, all with a different focus when it comes to ESG. And I think it just makes it very difficult. So at one stage, there was a move to try and harmonize ESG requirements and rating amongst sort of the more trade finance funds and alternative lenders. That sort of died a little bit with the rise of COVID and everyone not traveling and sort of taking the eye off the ball on that. But I think we probably need more harmonization. I know the ICC has been working with a number of the global banks on trying to harmonize ESG requirements, rating, what factors do you take into account. You've got companies like Correspondent Technologies trying to put a very basic ESG screening tool in place so that even if you've got a balance sheet and are listed on Dun & Bradstreet, you have one tick, you get a green tick on part of the ESG scoring. So I think there are efforts being made, but I think once again, it comes back to Duarte's point, African institutions that have these policies, spread the word, talk to your peers in your own market, and you have to educate your clients. Unfortunately, if you're trying to attract foreign capital, you just can't get away from it. It is a requirement, whether you're an alternative lender, whether you're a fund, whether you're a bank, your investors, your shareholders expect you to put out some form of sustainability report or ESG report. So I think we've all got to do it. It's just, can we get some harmonization going? I think it's very difficult because everyone has their own views, and it can be a very emotional subject as well. But I think that's where, through the initiatives of the various sovereigns, through the DFIs, I think as time goes by, this will probably come closer to sort of a more uniform approach. And I don't say Africa needs to be different from the rest of the world. I think every country faces the same issues, whether you're talking about England or whether you're talking Rwanda. ESG, we've all got the same issues to deal with, at maybe different levels and stages in our evolution, but we do need some form of harmony on that side.
Thanks, Ian. Yeah, certainly from a GTR perspective, just in the last couple of weeks, we've seen some socially linked loans happening across the African continent. So it's certainly not continent is not an outlier in what's happening elsewhere in the world. Anybody else want to pick up the baton on ESG? Ted, your hand was up first. Over to you.
Yes, no, just be very interesting. I think that's really interesting what you say, Ian, and I would agree a lot. I think it's actually 17 SDGs because they stuck on at the end, we've got to keep doing partnerships as well. But the SDGs, it's interesting the way they're divided up because, obviously it was torturous negotiations to get to them, right? No model is going to be perfect. The first half are very much about humans. Then there's a chunk which is environment, and that's really moved up the agenda. And then there's a lot of kind of wish list stuff, which is almost like, let's have a better society. And they try and fit stuff in there. But I think what is interesting is the way they've come out and shaped this whole debate about ESG, because it is becoming mainstream now and it affects all companies. And I think what is so complex about it is that if you really want to embrace and understand how you're trying to change the way you operate as a financial institution or as any kind of company as well, it's not just what is the carbon footprint that we do. It's not just, let's say, how much money do we lend to fossil fuel companies or what is our exposure to cocoa. It has to go much beyond that. You've got to think about all of your suppliers. And this is something that the big institutions have started to think. You've got to think about all of the people that you deal with. What is their carbon output? Do you, as an institution, are you able to influence them and say, we're trying to go towards a lower carbon, neutral carbon, carbon zero approach? We want to adopt, various different standards here. We're trying to go towards it. Can we help you do that? Because particularly when it comes to big banks and large finance institutions, they do have a disproportionate impact on the market. Sometimes if you take some of the gigantic institutions, if they literally, anything is said about them, that can actually move, interest rates or certain shares on the market, pension funds, etc. But even banks which are lending to a number of clients, they really can have an influence here. And so I think the real test here with the ESG is that, first of all, to actually understand the implications for your own business, it's not back at the envelope. It's actually really a lot of thinking, and it's like a box you keep on opening. And if you're like, well, if we're really serious about this, we know that we're completely, let's say, green to this point, but I actually know that after that, they just dump it all in the harbor. It's that kind of thing, right? How far are you prepared to go on that one? And that's a hard job. But the other thing is, there is almost an obligation, I think, there for a lot of the institutions to help the people, your suppliers, the ones you're working with on the process. There's always a certain amount of demands, but the other thing is to see, can there be a process here of using that kind of financial strength? Because we have to align with the ESGs eventually and with the SDGs, otherwise there won't be a planet left.
Well said, Ted. Now, finally, and we don't have much time, just the last few minutes, it's a really important topic that Makiko and others have touched on. And Makiko, I'll start with you. Yes. Is the topic of vaccines. So we know that governments and multinational organizations have called on the international community to bolster the continent's vaccine supply chain to respond to the virus, and also to promote longer-term health sector resilience. And we have seen some successes in that regard, again, reported by GTR. But what more needs to be done and what role can, you know, institutions like all of yours, private, public sector, fintech companies play in ensuring that this happens going forward? Let's start with Makiko.
Thank you, Shannon. I just want to bring up one thing. Based on the World Bank's estimate, every month of delay of vaccine distribution would cost about 14 billion US dollars in lost GDP for the African continents. So this is pretty important for the Africa to secure those vaccines. And then if you see the global procurement of COVID-19 vaccines, only 2% have been procured in African continent. So this is really a crazy situation is going on. What the African continent has to do is to produce a vaccine locally. And then this is why IFC is really focused on the local production of vaccine. IFC has just invested 600 million euro, working together with Proparco, DEG, and DFC to support one South African company that can manufacture a COVID-19 vaccine in the future. So this type of investment is really important for IFC that can actually lead COVID vaccine production in African continents that can maybe contribute to the neighborhood countries. But then as IFC, we think that the three things are pretty important in this space. First one is regarding this harmonization of the vaccine procurement. So in a way that the vaccine standard has to be pretty harmonized among different countries so that this local produced vaccine can be exported to the other countries. And then second thing is offtake agreement. I think if we think about sustainable market for the locally produced vaccines, you need to have offtake agreement. Otherwise, you cannot produce those vaccines. From that point of view, the national or maybe subnational procurement agency have to think how they can secure those procurement contracts, those private sector-led local productions. Otherwise, it is difficult for private sector to coming into this space. And then last one is about this trade policy that I mentioned a little bit that in order to create, to produce COVID-19 vaccine, you need so many different parts in these productions. So those inputs have to be imported to, for example, South Africa or any other country that try to manufacture COVID-19 vaccine locally. So this type of trade restrictions have to be corrected, and then also this border control, custom control, this type of regulations have to be enhanced. Otherwise, this imports to those countries would not happen. So those are I think the key element that IFC thinks that it is important to facilitate those local manufacturing of COVID vaccine. And then Shannon, I think you mentioned about the fintech opportunities as well. We think that this public and private partnership together with a fintech company, trade tech companies, this is pretty important for health sectors as well. As I said before, that without the vaccine, immunization and nothing would start in the African continent. So from that point of view, this type of partnership collaboration between the trade tech and then also those public and private, this is pretty important. And as multilateral development banks, I think together with African Development Bank and African Bank, IFC also have to make effort to facilitate those trade tech and innovation in this space so that we can promote this type of investment in Africa. We launched a global health platform during the COVID last year. And then this global health platform is really for us to focus on this healthcare investment in African continent. So far, we invested about 1.8 billion US dollars related to COVID-19. But then out of this 1.8 billion US dollars, 1.2 billion US dollars was actually out of this global health platform. So this is a kind of a platform that we'd like to focus in coming 6 to 12 months. Thank you.
I just want to say about a really interesting innovation that I saw during COVID about vaccines, and it was African, and I think it gets to the nub of what you can do with using technology and African innovation. So I don't know if you know the company Zipline in Kenya, an American company. They have a drone, and that was used often for delivering medicines. Well, it was adapted for delivering vaccines. But what was so interesting is they had a very good distribution network going there. I mean, in Rwanda, it means you could get to a village in 2 hours with a vaccine rather than 3 days on a motorbike. But the point is, they actually from the very start sat down with the vaccine companies and came up with a cold chain system. So it could immediately be fit into the distribution system they had, and it means they can vaccinate all over Africa. But I just thought a really good example. That's a US company originally, it's a Kenyan innovation, and ultimately working with the vaccine companies to try and resolve this issue of distribution.
Shannon, if I may, just very quickly as well. I was absolutely delighted with Makiko's intervention, and I think the issue of local production of vaccines is absolutely critical, and I'm pretty sure that both African Development Bank and Afrexim Bank will align with the IFC's views, because even at Crown Agents Bank, we are heavily invested in deploying a fintech-led financial infrastructure, for example, to pay health workers. I think the estimate is for each person administering a vaccine, there will be another 8 working on the vaccination center, just providing the assistance. And how do you pay all these people? It needs to be through mobile banking technologies and mobile money and so on. So again, just reiterating, Africa's got the fintech, Africa's got the drive, Africa leapfrogged everybody else because of fixed telephony infrastructure problems, which made it go straight into mobile. So the question really is how to create this independence that doesn't put us in a position where we can at best aspire to vaccinate 20% of the continent's population by the year end, when quite a few of these so-called developed countries are already fully vaccinated. But, globally, we're only as strong as our weakest link as such. And frankly, given all the effort that Africa has put into prevention on the back of the Ebola experience and malaria experience and so on, and the cost that has had to local economies, it seems rather unfair that Africa as a continent is now left to the tail end of economic recovery simply because it's so dependent on the goodwill of other vaccine producing nations.
Thanks, Stuart, and thanks to you all. I think we have to leave it there. Next time we'll be sure to schedule in more time because I think this has been a really important discussion, but I know that there's a lot more that can be said. So on that note, thank you from me at GTR, and thanks to Crown Agents Bank for co-hosting this discussion with us.